In today's video, I'll be revealing the hidden Roth conversion traps that catch many retirees completely off guard and can cost you thousands of dollars in unexpected taxes, penalties, and Medicare surcharges. Through working with countless retirees over the years, I've seen even the most sophisticated investors fall into some of these mistakes. And that's exactly why I'm making this video today, to share the Roth IRA conversion traps that can derail retirement plans and show you how to avoid them. So if you're new to the channel, my name is Ben. I've been a financial advisor focusing on retirement plans for almost 20 years, and I want to help make your retirement even better. So trap number one is the hidden 2-year tax time bomb. Many retirees see the value in Roth conversions, many of which we've, of course, demonstrated on this YouTube channel. And those retirees also know that Medicare premiums can increase if your income is too high. Since Medicare starts at 65, many assume that that's when the penalties are going to begin. But really, here is the trap. Medicare actually looks back 2 years when calculating your premiums. That means if you get excited about Roth conversions and you start to make aggressive Roth conversions at 61 and 62 and 63 because you want to reduce future income and you want to reduce your Roth conversions once Medicare starts, you probably feel like you're off to a really good start with reducing your lifetime taxes. But then the letter from the IRS arrives at 65 and says, hey, congratulations, now you owe hundreds or maybe even thousands of dollars more in Medicare premiums. So let's just take a moment and cover exactly what those numbers are. And we're going to look at a chart here in a moment. But in 2025, a single filer under $106,000 of income pays just the standard $185 a month for Part B. So if you go just a bit over that, over $106,000, and your premium jumps to $259 a month, that's the $185 for your Part B plus a surcharge. That's an extra $888 a year just for crossing the line. So for married couples, we can go ahead and double that threshold. We can earn all the way up to $212,000 as a couple without paying anything additional for Medicare. Still pay your Part B premiums, of course. From $212 to $266, that's where we see that first increase, and it'll be about $1,800 more per year. Again, all because of Roth conversions we made 2 years earlier. So just a little side note, did you see how those IRMAA brackets doubled for married couples? Right, we went from single to married, and those brackets doubled. So can you guess what happens when a married person becomes single? You guessed right, they drop back in half. So this is one component of what we call the widow's tax, and it can be really damaging to your retirement plan if we don't plan for this ahead of time. Again, that's why a lot of people do Roth conversions, is to get out in front of this widow's tax. Widow's tax is a very big deal. So remember, if you're married, you're going to start retirement as Fleetwood Mac, and you're going to end retirement as Stevie Nicks. Now, if you're a little bit younger, I'll change my references. You start retirement as Destiny's Child, and you end retirement as Beyonce. So the IRMAA sneak attack is what we'll call that, and that's bad enough. But misunderstanding marginal tax brackets versus IRMAA cliffs can make that trap even worse because of missed opportunities. All right, moving on to trap number 2, what we call in for a penny, in for a pound. And there's 2 things that really drive me crazy about IRMAA. And the first one is that the M in IRMAA, IRMAA, the M, which is a rule that applies exclusively to Medicare, well, the M does not stand for Medicare. It stands for monthly. Income-related monthly adjustment amount. Am I the only person that bothers? It's bothersome for me. But the second thing that drives me crazy about IRMAA is that one single stinking dollar can mess up your Medicare for an entire year. And you probably won't know about it for 2 years. And that's why I'm including this as a trap in our video about Roth conversions. So here's where retirees really get confused. And it involves 2 really popular misconceptions. Many people believe that if they get $1 into that next tax bracket, that all of their income is now suddenly taxed at that higher rate. And I'll show you what some numbers look like. So 2025 brackets for single filers, we pulled this from the IRS. We pay 10% of income up to just under $12,000, then 12% from $12,000 to just under $50,000, then 22% from $50,000 to $100,000, 24% from $100,000 to $200,000. You sort of see the brackets here. If we look at the numbers in more detail to understand the first misunderstanding, so suppose a single filer has $100,000 of taxable income in 2025. That's going to place them fully within the 22% marginal bracket. That makes sense, right? What happens is only the income above $103,350 is taxed at that 24%. So we still have income in each of those brackets when we're at $100,000. When we jump over $103,350, that income stays in those brackets, and just the amount over $103,350 is taxed at 24%. So the misconception that we're going to talk about with our marginal brackets, it's exactly the opposite for IRMAA. So understanding the misconceptions will help us understand the correct way for both. So the misconception here is that if someone earns an additional dollar, that they'll now be in the 24% bracket, and that means all of their income will now be in the 24% bracket. But here's how it actually works. We've got a little bit of income in each bracket. So first, $11,925 is taxed at 10%, and then it's done being taxed. Everybody that earns $11,925, whether that's your exact income or you earn $50,000 or $100,000 or $500,000, that first $11,925 taxed at 10%. Then the next $36,550 from $11,926 to $48,475 is taxed at 12. Then the next $54,000 is taxed at 22%. And then that final dollar, if that's what it actually is, that final dollar is taxed at 24%. So the actual cost of tipping just that final dollar into the 24% bracket, it's not thousands of dollars like many people would expect. It's very likely just literally 24 cents more in tax based on that dollar. But here's where it gets crazy. For IRMAA, that is exactly how IRMAA works. It can be a very big deal to earn $1 extra. Now let's look at this image that I politely stole from my good friend Devin Carroll. If you're not familiar with Devin, he's one of the top Social Security experts in the country. Social Security Intelligence is his blog, or check out Devin Carroll on YouTube. You probably already know who he is. He's got like 500,000 subscribers, way more famous than me, but I stole this chart from him. Let's look at it. Let's say that you're a married couple right at that $212,000 income mark. If you stay under that, excellent. You pay the standard $185 a month for Medicare Part B each. Now, here comes that evil dollar. If you go $1 over $212 and $1, then suddenly you're in the $259 per month each zone. That's an extra $1,776 for that household. Yes, $1,776, a very patriotic amount, ironically, all because of one measly dollar. That's why in our office we say, if you're in for a penny, you're in for a pound, right? With IRMAA, just being $1 over means you pay that higher premium just as though you had $10 or $1,000 or $10,000 or filled up the entire bracket. You still pay that same IRMAA penalty, whether you're $1 over, you fill up the whole thing. So crossing the line, if that's completely unavoidable, well, the smart thing to do might be to fill up that entire bracket. And that's where this strategy comes in. Once you are locked into that higher IRMAA tier, and there's nothing you can do about it, let's say in this hypothetical example, it's totally unavoidable, well, then we can use that to our advantage by pulling more income from the future into the current year. Based on the client's goals, could mean a lot of different things, but it often means doing additional Roth conversions. Well, hey, we're in this tier anyway. We're forecasting we're going to be $1 into it. Might as well fill it up more. Or we could look at harvesting capital gains, right? We've got deferred gains in some stocks. We could bring that forward and make that money more liquid on like an after-tax basis. We could think about taking IRA withdrawals to fund larger purchases or gifts that we're giving to family in the future. So let's say 3 years from now, you've got a big Disney trip planned, or you want to buy a new vehicle and it's $50,000 and we're $1 into the next IRMAA bracket that's totally unavoidable. Well, we could look forward and we could say any big purchases on the horizon, bring that money into this year, fill up that IRMAA bracket. Yes, we have to pay additional taxes, especially if it's coming from an IRA. But now we've created additional liquidity for future years just by understanding and following the concept of in for a penny, in for a pound. If we're in this IRMAA bracket, it probably makes sense to fill it up more. So now why do we do this? Well, because the alternative is to let that income show up in the future when it could push us even higher into more IRMAA brackets. Remember, we're paying like $75, $80 each on the lower IRMAA brackets. Those can get as high as $300, $400. I think it taps out at like $500 or the high 400s per person. So double that for a couple. So if we're early on in retirement and already having IRMAA trouble, we might want to pull more income forward to make future years a little bit less likely that we'll hop 2 brackets or 3 brackets or 4 brackets into IRMAA. So remember, retirement cash flows often rise over time because of inflation adjustments to our Social Security benefits and our RMDs, required minimum distributions from IRAs. So if IRMAA, again, is an issue now, will it get likely worse later? It seems likely. So reaching into the future, bringing that income forward today, whether it's Roth conversions, just spending the money, tax gain harvesting, right? We can potentially reduce future RMDs, smooth out income, create more after-tax liquidity by implementing this in for a penny, in for a pound. There's a lot of power in that idea. So if you are forced into a higher IRMAA bracket anyway, strategically, under the guidance of a plan, thinking about taxes, maybe pull more income into that bracket, and you'll just buy yourself more flexibility in the future. But here's another danger. Many retirees try to thread the needle and stop just $1 short of that IRMAA line. Now, on paper, that looks brilliant, but in reality, it can often backfire. And that's trap number 3. Close enough does count. Now, I've met with plenty of retirees over the years who come to me with beautiful spreadsheets showing the Roth conversions every year of retirement planned down to the exact dollar, and that dollar is usually $1 below that IRMAA threshold. And from a spreadsheet perspective, it looks amazing and impressive, and it makes perfect sense. You want to get as much out of your IRA as possible to minimize future taxes. So the problem is, real life is not a spreadsheet, right? There's always some mundane minutia, some tiny piece of income that we either forgot about or we underestimated. And when that last dollar, that last dastardly dollar shows up, the perfection of our whole spreadsheet unravels. Suddenly, we are $1 into the next IRMAA bracket after the year has already closed, and there's just really no easy way to undo that. So what would be some examples of income that could throw people off? A capital gain distribution is probably the most common. If you've got an after-tax account, mutual funds or stocks that's kicking off either dividends or capital gains, that could be something difficult to account for, especially actively managed mutual funds, because that can kick out a capital gain. Even if you don't have a gain that year, you can realize a gain, and they're often distributed later in the year. So that can be tricky to plan for ahead of time. And the second piece I've seen people trip up with is interest from a savings account or money market. It's hard to blame somebody to forget about this because for decades, in fact, I think the first maybe 15 years of my career, money markets paid nothing, and they paid nothing for decades. 0.006 was the standard sort of interest rate. But now that interest rates are higher, a nice savings account can kick out several $100s of interest per year. So it's easy to overlook if you're used to a decade of it paying nothing. So that's why we say close enough counts with horseshoes, hand grenades, and Roth conversions. Buy yourself a little wiggle room, right? Leave a buffer of at least a few $100s, maybe a couple thousand, depending on your income level and just depending on your tolerance to be a dollar over. Because the math really doesn't work in your favor to get for that last marginal dollar, right? Think of it the other way. The benefit of squeezing one last $500 of conversion versus the potential hundreds or thousands of dollars we could face if we're $1 on the wrong side of IRMAA, that math is never going to work out, right? So the tip would be give yourself a few $100s or a few $1,000s of room. Don't run it up $1 below that bottom IRMAA bracket. Now, here's one more tip in this area. This is why in our office we do Roth conversions for our clients as late in the year as possible. So we usually calculate the conversion in November when we have our year-end tax planning meeting, but then we actually logistically move the money from the IRA to the Roth in December. We just want to wait as long as possible because we have a better understanding, a more confident understanding of where our actual income is going to line up by the end of the year. I've seen many times where a podcast listener gets excited about Roth conversions. They do their big conversion in March, planning for the entire year, and then something happens, right? They have to replace a car. They have, a hailstorm where they have to replace the roof, something like that. And they have no more room in either marginal brackets or IRMAA brackets or whatever they're planning around because they did that conversion too early. So something to think about. That's personally why we wait so long. And if you're already wondering how to keep IRMAA cliffs from making you pay avoidable taxes, click the link in the description and book a call with me. I'll walk you through how to build a Roth conversion plan that's going to avoid a lot of these surprises. Now, conversions can also backfire when people forget that there's really no free lunch. Paying too much money in taxes up front can really bite us if we die too soon. And that's tax trap number 4, the not a free lunch tax trap, very creatively named by myself. So understandably, people get really excited about Roth conversions. They watch our video, they watch how they can save maybe hundreds of thousands of dollars in taxes over someone's lifetime. And so they get really excited and they do Roth conversions. Hard to blame them. I love Roth. I love Roth conversions. But like anything else in life, there's really no such thing as a free lunch. So looking at overly simplified math, let's say you convert $100,000 from your IRA to your Roth and you pay $20,000 in taxes. Of course, you're not going to start with $100,000 in your Roth. You're going to start with $80,000 because you paid taxes. Even if you pay taxes from another source, let's say you actually do end up with $100,000 in your Roth and you paid taxes from your checking account. Really, from a net worth perspective, we are still short that $20,000, whether it's actually in the Roth or just represented somewhere else in our net worth. So you're down $20,000 for kind of an unknown amount of time until your portfolio returns will just build it back up over time. And honestly, that could take years in your Roth IRA. We have to have good growth to sort of get us back to even or get us ahead of where we would have been. And if you have the terrible luck to pass away unexpectedly, well then, unfortunately, you pay tens of thousands of dollars in taxes that you personally are not going to be able to get the enjoyment of, whether that's spending the money or just saving the money on taxes. Granted, yes, your spouse, if you have one, or your heirs will benefit, but that's probably not why you did the Roth conversion anyway. So this alone probably is not enough to make you reconsider a Roth conversion if you already see the benefits of doing so. But I think it's important to think about what could go wrong if life or lack of life doesn't go exactly as expected. And of course, you've been investing for a long time. You know that very few things in life are all upside with absolutely no possibilities of downside. So what's the lesson here? Well, Roth conversions are really a timing bet. You're making a bet that you and or your spouse, if you have one, and or your beneficiaries, if you have those, some combination of those people are going to live long enough to see a benefit because investment balances are going to go up, taxes are going to go up, whatever it is. You see a benefit from pulling those cash flows forward and paying taxes now. So this kind of advanced retirement planning, it really requires context, not just enthusiasm for the strategy. Now, and speaking of taxes, we do still need a plan to pay for those taxes, which brings us to our final tax trap, number 5, the cash flow and early withdrawal penalty trap. And this is one that catches a lot of people by surprise. If you're under 59 and a half and you withhold taxes from the conversion itself, the IRS does not consider the taxes paid as part of the conversion. They treat it as an early distribution. So let's say you convert $100,000 and you withhold $20,000 in taxes, and you're not 59 and a half yet. Not only do you still owe the $20,000 in taxes, of course, you also get a letter from the IRS that says, hey, you withdrew $20,000 early. Even though you paid it in taxes, we still view that as a distribution, which means an extra 10% penalty, $2,000. So instead of paying $20,000 in taxes, you're really paying $22,000 all in, part tax, part penalty. And now we've permanently reduced our portfolio by $22,000. That's hard to make that math work, right? So we want to avoid penalties. Now, here's a little bit of extra nuance that could be a retirement tip if you're the right age and you have the right tolerance for extra middlemen and extra pieces. If you are over 59 and a half, withholding can actually be a really smart strategy. In fact, we often recommend that because one, who wants to pay quarterly taxes, right? You're retired and you're out having fun. But withholding is unique in that it's viewed as equally distributed throughout the year. Even if it happened right at the end of the year, it's viewed as equally distributed. And really what that helps us do is it helps us avoid underpayment penalties and interest and penalties, whatever that would be. In addition to that, and this is a bit of a clever bonus, if a client has a really high annual tax bill, maybe their income is really high, maybe they made a big gift to family members, maybe they made a big purchase, houses are a very common one. If they've got a really high tax bill, we can actually leave those dollars invested in the IRA in the money market piece for most of the year. And many times we can earn the client hundreds or even thousands of dollars in extra interest. Remember, without withholding, and we buy a house in January, we're going to have to send our tax money in January. But if we plan ahead and we say we can pay that tax through withholding, we get to keep what we would have sent in taxes from January all the way to the end of the year. And then December 12th or whatever it is, we send that money in through withholding. So if the tax bill is $50,000, well, we got to keep $50,000 in our IRA the entire time in a money market at 4% or 3 or 5%, whatever money markets are paying. That's real money from taking kind of just a couple extra steps. So if you have the tolerance for some of the details, maybe that could make you a couple extra $100 or a couple extra $1,000 this year. So I don't want to get too off topic here. I personally am not a Roth purist, right? There are some that insist all taxes come from outside funds, right? So you do a $100,000 Roth conversion, we need to move exactly $100,000 from your IRA to your Roth. I don't believe that. In fact, for many clients, really the focus isn't maximizing what goes into the Roth IRA. That's just where the money ends up. The focus is getting money out of the IRA because we're trying to right-size the IRA for our income needs and not spike our income with RMDs later on. So the Roth is just where the dollars end up. Really what we're solving for is I want less money in my IRA. But before I get too far off topic, the trap is if you're under 59 and a half, early withholding is going to create an early distribution penalty. If you forgot about that, that surprise penalty can wipe out a lot of the benefits, the math benefits of your Roth conversion. So if you want help developing a Roth conversion strategy that avoids a lot of these traps while still maximizing our tax benefits, go ahead and click the link in the description, book some time on my calendar, and we'll analyze your specific situation. We want to make sure you build a plan that protects, not penalizes your retirement. So that's what I got prepared for you this week. My name is Ben. I hope this video helped to make your retirement even better, and I will see you on the next one.